Imagine two investors. Both have the same ETF portfolio, the same income, the same discipline, and the same long-term goal. 20 years later, one quietly retires early, travels, and never worries about money again. The other keeps working, stressed, confused, and angry at the market. The difference was not timing, intelligence, or luck. It was one small ETF mistake that looked harmless, felt responsible, and cost hundreds of thousands of dollars in real spending power. This video is not about hot picks or secret tickers. It is about a structural error almost everyone makes because it feels safe. I have seen this mistake destroy otherwise perfect plans, especially for high-income professionals who think diversification automatically means protection. The irony is brutal. The more disciplined you are, the more damage this mistake can do if you never question it. Here is the setup. You buy a broad market ETF. Low fees, great reputation. You hold it for decades. You rebalance occasionally. On paper, you're doing everything right. Your statements grow. Your net worth chart looks impressive. Then retirement arrives, or a major life change forces withdrawals. And suddenly, the math stops working the way you expected. Not because the ETF failed, but because of how you owned it. The mistake is confusing diversification with risk control. Most investors believe that holding multiple ETFs, especially stock and bond ETFs together, automatically reduces danger. What actually matters is how those ETFs behave when you need the money. Correlation during stress is what decides outcomes, not labels. Let me show you how this plays out in the real world. Picture an investor who builds a classic portfolio using a total stock market ETF and a broad bond market ETF. 60% stocks, 40% bonds. It looks conservative. It looks professional. It even matches what many target date funds do. For years, everything feels fine. Then a bad sequence hits. Stocks fall sharply. Bonds also drop because rates rise or inflation spikes. This happens more often than people admit. Now the investor needs cash. Maybe they retired. Maybe a business slows down. Maybe medical expenses appear. They sell shares at depressed prices, locking in losses across both sides of the portfolio. The ETF choices were not wrong. The structure was. This is where hundreds of thousands quietly disappear. Losses early in withdrawal years permanently shrink future compounding. Even if markets recover later, the sold shares are gone. The portfolio never catches up. On a spreadsheet, this can easily mean the difference between pulling $40,000 a year and $70,000 a year for life. Here is the uncomfortable truth. Broad ETFs are accumulation tools, not withdrawal tools by default. They are designed to grow efficiently, not to protect you from sequence risk. When investors ignore this, they mistake volatility smoothing for safety. They believe bonds always stabilize portfolios. Sometimes they do. Sometimes they absolutely do not. The real issue is not which ETF you chose. It is that you treated your ETFs like a single bucket instead of separate machines with different jobs. Stocks are for long-term growth. Bonds, in a well-designed plan, are not there to boost returns. They are there to buy you time. Time is the real currency. The investor who survives downturns is the one who does not have to sell growth assets when prices are down. The mistake is holding bond ETFs without defining their purpose. If your bond ETF drops at the same time stocks drop, it has failed at its only important job. Wealthy investors who understand this think differently. They do not ask what percentage is in bonds. They ask how many years of expenses are protected. They separate growth from survival. They design their ETF portfolio around cash flow, not just allocation charts. Imagine two retirees with identical ETF balances. One has a bond ETF that covers 5 years of spending in stable assets. The other simply owns a blended stock-bond portfolio. When a crash hits, the first person does nothing. They live off their buffer and let stocks recover. The second person panics or is forced to sell. Same ETFs, completely different outcome. This is why the same ETF portfolio can produce wildly different retirements. One investor experiences volatility, the other experiences ruin. The market did the same thing to both. Structure decided who survived. Another layer of this mistake shows up in taxes. Many investors hold the same ETFs across taxable accounts, traditional retirement accounts, and Roth accounts without thinking about withdrawal order. Selling the wrong ETF from the wrong account at the wrong time compounds damage. Taxes accelerate losses, require distributions for selling. What looked efficient on paper becomes fragile in reality. The solution is not complexity, it is clarity. Every ETF in your portfolio should have a job description. Growth ETFs are never touched during downturns. Stability assets exist solely to fund life when markets misbehave. Tax-free space is reserved for the highest growth. Taxable space is managed for flexibility. This is how the same ETFs multiply wealth instead of draining it. If you want a simple rule, here it is. If you cannot explain exactly when and why you would sell each ETF you own, you do not have a plan. You have a hope. Hope feels calm in good markets. It collapses under pressure. The investors who avoid this mistake are not smarter, they are more honest about behavior. They assume fear will show up. They assume bad timing will happen. They design their ETF strategy to work even when emotions are loud. This is why some people with smaller portfolios retire better than people with larger ones. They did not chase performance. They respected structure. They understood that the goal was not to maximize returns, but to avoid catastrophic selling. So before you buy another ETF, ask yourself one question. When the market drops 30% and life demands cash, which asset pays the bill? Answer it now before stress decides.